All right. Hey, everybody. Welcome to this webinar where we've got a couple of lovely guests. It's been a crazy 72 hours. I think this will go down in the history books as a masterclass or a Harvard Business School case study in the next couple of years. But I do want to kick off this session with a quick round of introductions so we get ourselves settled in and we can dive into a number of topics that we have for you guys here today. And in this session, we'll learn from traditional finance, retail crypto, retirement, and crypto security experts as we tackle through some of the tough questions. It's very tough past 72 hours as we close out 2022. We'll actually start off with the discussion around what is happening between Binance, FTX, and the rest of the crypto market, followed by conversations around macro and regulation, investability in these assets, and round it out with a discussion around security. So I will kick things off with a quick round of introductions with those who I see on the screen. And just give your quick background, what you like to share with the team, and how you got red-pilled into crypto. So we'll start with Mr. Hank Holland.
Great, thanks. Again, Hank Holland. I'm a family office private investor as well as a private equity investor. For me, the interest initially was Bitcoin, albeit I've invested in other protocols as well. Bitcoin from a macro perspective as I began to look more and more at store value assets, given the nature of the monetary policy of recent years, as well as geopolitical issues. And so that's really what got me engaged. And it's been fascinating. It's been fascinating to me see the macro events unfold much as I expected, i.e. the rate markets, the currency markets, the shock that we've seen as the monetary policies begin to unwind. And yet it's been painful to see that in the near term, Bitcoin hasn't been more defensive. And yet I don't know that it has a lot to do, as we'll talk later about the longer term justification of kind of where the asset plays in the portfolio. But very much my interest has been looking at alternatives to fiat currencies, and as well as looking at alternatives to having trust centralized organizations. We've got another set of challenges that's came about today. But that's my interest. Thanks.
Thanks, Hank. We'll certainly lean on your view from the as a private investor and a view on the macro markets here today. I'll move over to Mr. Chris Kline.
Oh, hey, folks. So happy to be here, Hank. It's great to see you, and Mike as well. Chris Kline, co-founder of BitcoinIRA. My red pill moment was 8 years ago, actually, just around this time 8 years ago. I'm starting my ninth year at the turn. And we were deep into retirements and alternatives, and crypto just made sense as an option back in 2017. Excited to talk about where we're at today, and we couldn't have named this webinar better, Thomas. Where do we go from here? It's a perfect fit.
Absolutely, Chris. Thank you. And Mike. Mike, you're on mute.
Hey guys, pleasure to be here. Sorry about that technical difficulty. Not sure how I got turned off, but okay. My name is Mike Belshe. I am founder, CEO of BitGo. We are a crypto wallet as a service platform and custodian, and we've been operating since 2013. So I got excited about crypto, in particular Bitcoin, back in 2012. I'm a technologist by nature. Been doing all technology for my career, and what fascinated me was the intersection of money and software. We now have, for the first time, the ability to transmit money natively on chain, directly from any machine anywhere. And this is a game-changing element. We are going to see the intersection of money and software, not just at cryptocurrencies and investment levels, but we're going to see it invade every aspect of our daily interactions with software. Examples you see.
Well, we might have lost Mike there, but definitely I know what he's talking about is that what excited him most was that crypto was going to change the way we looked at not just the way our lives work, which was Web 2, but how money works, which is Web 3. But I think we can jump right in, and Mike will probably join us here in a second. Thomas, go ahead.
Yeah, no, absolutely. Just to round out, Mike's thinking process here. By the way, for those who don't know me, really, really quickly, acting global head of sales here at BitGo, joined in 2018. Joined BitGo because we frankly have a front row seat, think like courtside seats to an NBA game, of crypto, right? Because we serve as a pillar in crypto, which is security and wallet infrastructure. Hey, Mike, sorry you got cut off at the tail end there. Do you want to just finish up your introduction?
Sure. Look, I think we're going to see crypto invade many aspects of our lives. It will be in our taxi cabs natively. It will be in your loyalty programs. It'll be in your points that you earn when you go to Starbucks. It will be everywhere. So it's a fascinating time, and it's an incredible time to be involved with an emerging market and product class.
Never a dull moment. Definitely not the past 72 hours. So we'll kick things off with a discussion around what is actually happening. For the uninitiated, what has happened in the past 48, 72 hours? Binance, one of the largest global exchanges, was in the process, this is how quickly it's developing, right? Was in the process of acquiring rival exchange FTX after FTX experienced a liquidity crunch, which could have been catalyzed by Binance amidst this whole market uncertainty. FTX, what had happened is they had their financial statements leaked and showed a majority of their assets were actually illiquid or locked. There was some fear there, and a lot of users and traders started pulling funds out of that exchange. Somewhat irony in all of this is SBF, Sam Bankman-Fried, the founder and CEO of, founder of FTX, was rescuing a lot of crypto firms a couple of months ago, and now he needs rescuing, right? So this has been a story about market infrastructure, untransparent markets, and middlemen. We'll actually kick things off with a quick question to Chris and Mike. So from a macro and regulation perspective, we saw events with Three Arrows, Luna. Crypto is actually very intricately tied together, and when one domino falls, there could be contagion to the rest of the industry. Where do you see this headed? When does it stop? And how do we regain credibility again as an industry?
All right. Well, let's see. Do we have 2 hours to tackle all of those questions in Mike's response?
We've got one.
Look, I mean, we have an early market here, and because it's so different, it hasn't been able to fit in with the existing financial system. Now, the existing financial system has been built over decades, has had many failures, much bigger along the way than what we're seeing right now in crypto, kind of what seems like a regular cadence. But the whole reason we're doing this build out of regulated custodians and regulated exchanges, et cetera, is because we're building this market structure. It's coming together, but it does come piece by piece as the industry grows. So today is probably mostly a proof point that, we need to figure out, what the market structure is going to look like. We can't have single entities, whether it's Bernie Madoff or, anybody else, having all access to assets. You need checks and balances. A lot of it's kind of about security principles of how do you make sure that no single party has undue influence, and so that investors get total understanding of what it is that they are investing in, what the risks that are being taken, either directly by themselves or by others with their money. So with every great failure, as long as we learn from it, maybe all new mistakes is a quote that I sometimes use from Jim Barksdale. And we're seeing some of those, and it's going to help us form our market structure to make sure this doesn't happen kind of again.
I agree with the way that Mike put that. And I do want to reiterate the traditional banking system has been through a lot worse and many times in my lifetime, in fact, in 37 short years. But the next element I would say is this is a game of layers. So the fundamentals haven't changed. You're still, and you mentioned all three of us started by a Bitcoin. And it's kind of the foundation, the core of what is crypto and what's been built since. And so there's layers now that have been created. The first layer was new protocols. The next layer was DeFi and these elements of CeFi and things where we found obviously weaknesses this year in particular on. So this is a piece of the overall pie. I think sometimes what happens when you're either just coming in or fresh to crypto is if one piece fails, everything fails. We're bigger than that now, but we're not big enough that we would have impacted the entire economy. So this is something we're going to have to, with self-inflicted wounds, self-inflicted healing that we're going to go through together. But I think the opaqueness that Hank said and the transparency that happens with blockchain is what makes this beautiful. This is something that happened very quickly in 72 hours, a lot of things happened. The part of it was the leak of financial statements, but you see a lot of things on chain now that make this this space special. So we're going to learn from this, and that doesn't kill you; it only makes you stronger.
Yeah, absolutely. Just tailoring on to what Mike had said. So as software eats into the financial tech stack, right? One can actually view the financial tech stack as almost like money Legos, if you're familiar with the space, right? Depending on what you're doing, you can have a foundation, and if you're exploring DeFi, you can certainly stack different yields and rates and get some sort of money Lego structure, if you will. I guess the question then is, for Chris and Hank, when you look at this stack of money Legos, how do you account for the risk? How do you navigate this as an individual investor? And what should investors be thinking about when they look at crypto? Is it just a fundamental Bitcoin, or how should they start thinking about all the additional innovations that have come post Bitcoin and built on Ethereum?
Hank, you want to throw in your perspective?
Yeah, I think it's an interesting question. I would say that there's two aspects to the question, right? You know, I've spent my entire career in finance. Whether it's structured finance or various more esoteric parts of the market, I have an understanding of finance that the average consumer in finance doesn't, right? And so a lot of people on this phone will be very familiar with L1s and various protocols, but the only way the ecosystem will be successful is, to the average investor, they have to have trust. They have to believe that there's integrity in the plumbing, that there's integrity in the marketplace, and that bad actors do not proliferate the marketplace, right? And so something like this happens, it'll have fundamental change. It'll result in perhaps an expedience of certain regulation that might have otherwise happened over time. But the other question then is just perception, if you will, right? And I think, to Mike's earlier point, a lot of this is just indicative of the immaturity of the systems, the immaturity of the ecosystem that's being built. I do think one of the great things the asset class has going forward, I happen to be in Dubai right now. This is the case all over the world. The number of incredibly talented, smart people, the talent that has been drawn to this sector, in my estimate, far more so than the capital that's been drawn to the sector, is one of the most promising things about going forward. And so you've got this enormous installed base of human capital. And that's still there, right? That hasn't changed from yesterday to today. It hasn't changed from before Terra to today. And that will continue to build off of. But we cannot lose the trust of the average consumer, or you'll also lose the narrative.
Yep. It's a trust-based system. It's trustless, right, Mike? That's what makes it different. But if you lose that piece, which that's where I go to the fundamentals, is that while this is going to hurt and we're going to see the price continue to move in directions and a volatility to increase, go fast forward 6, maybe 9 or 12 months, and we're going to be having a different conversation, because what's happening in trust in the general economy amongst fiat currencies, what's happening in Europe with the euro, US dollar here with the Federal Reserve and the Treasury, these things haven't changed. And the pains from them are being felt at 8% as inflation is, but an enduring inflation factor. Those things won't change for folks. And Hank, as an active investor in crypto, is probably part of your outlook. Wouldn't you agree?
Absolutely. And the macro side, something we might be talking about here a little bit, I feel very strongly about. And the one thing that I'll wait on those comments, but the other thing I would add is, I would note, I think everyone in this call would agree that blockchain and decentralization in general, right, is a fundamental precept of what we're talking about. Every failure we've had has been centralized.
Yep. Right.
It's really important to understand. And we will have centralized nodes, and we'll always have centralized nodes. But these failures would not have occurred had you had a decentralized system. And again, not just it's necessary to have centralized nodes, right? But these were not a failure that were fundamental to decentralized finance.
Yep.
So we've got a little bit of a long-term view around fundamentals. Let me laser focus this as something hyper short-term just for a moment here. Tomorrow, we also have the CPI print. Whatever that comes out, how do you think that may or may not affect what's going on with the crypto markets today? We've seen a decoupling today on the wrong direction to our chagrin. But how do you feel the macro environment of the CPI print coming out tomorrow may or may not affect the markets in crypto? Do we think we're so wrapped up in the FTX Binance phenomenon, or do you think the fundamentals will prevail and the markets will continue to develop as they always been?
I'll take this.
I would throw in. Oh yeah, Mike, go for it. I mean, I have a couple of thoughts, but you probably have a better one on it.
No, well, so generally the Bitcoin thesis is that having a monetary system, a cryptocurrency that's got a fixed supply that ends up being a deflationary currency, will over the long term decouple from, traditional markets because it doesn't have the same influence and conflated factors that cause it to change in the same way. I believe this will come true. However, today, the digital asset space is very, very small. We're sub-$1 trillion in global market cap across all coins at this point. And because of this, instead of looking at the long-term view of the asset, you have a lot of people, speculating on the asset. And because of the volatility, it is deemed a high-risk asset. So in times when you have inflationary periods, in times when you have economic and monetary policy uncertainty, which is what we have in the US, as well as every other country on the planet right now, when those inflation reports come out, that causes people to flee to safety. You can now get safe bonds at relatively high rates. And what do you take in order to do that? Well, you take your high risk assets. And Bitcoin and cryptocurrencies fall into that camp today. Now, one of the great things about intersecting, long-term investment thinking, retirement thinking with crypto is that, look, if you believe in, the 10-year plan and the 20-year plan of what's going to happen, in particular with Bitcoin, I'm talking about here, and monetary policy globally, you don't have to worry about what happens today or tomorrow with the up and down price. The markets are working to make Bitcoin and digital assets ubiquitously accessible across the planet. The volume and size of the assets will absolutely go up. As Hank noted earlier, blockchain technology is just getting started, and as it gets bigger, then the overall size gets bigger. As that gets bigger, the volatility goes down, and then now we can start to see some of the decoupling that we're hoping for. But it's a long-term view, and you need to be ready for that. And if you are, it can be a great thing to invest in.
And one thing I would add to that, and I totally agree with all those comments, I think we'll look back and the price action in Bitcoin and the rest of the ecosystem, it really has had nothing to do with inflation from a causality standpoint, a correlation standpoint. I think it's real simple. We've taken liquidity out of the system. It's that simple, right? This goes back to the Fed and this inflection point that we're in. And so this is an induced response, if you will, long-term, right? I think a lot of us who believe in Bitcoin believe it'll be important when we move to debase the US dollar. We've had to the contrary, right? We've had incredible dollar strength, right? Far from debasing the US dollar. And so in my mind, the sell-off that we've seen in Bitcoin is not saying that the correlation is broken from this inflation hypothesis many people have had. It's purely a function of we've taken so much liquidity out of the system, which in turn, high-risk assets, high beta assets, right, have had to adjust into.
Yep.
As a quick admin note, Hank, I think you might need to come a little closer to the mic so we could hear a
Yep,
little bit.
thank you.
Great. And just to piggyback on what you said, so liquidity has been taken out of the system. What does it take for liquidity to go back in, right? Obviously, all eyes are around regulation. How do we help the audience here today think about what are some of the themes in the regulatory landscape? Obviously, myself, not a domain expert here, but in my mind, there's three things, right? All I hear about is CFTC and SEC kind of jockeying position. I hear about SAB 121, and then I also hear about SEC now approving different type of ETF products, but yet Fidelity just launched a crypto retail trading product that's fee-free. Like, what are some of the regulatory catalysts or triggers that we should, or signposts that we should be looking out for as the space continues to develop?
Well, I actually last week was talking about this, and I thought that this year was a year of posturing and research. And it kind of started with Biden's executive order in January, February, in that time period in Q1. And it kind of rolled into a DOL statement as well that happened. The Department of Labor came out against one of Fidelity's products that they put out there for 401ks. And so where we're headed is, even with the last 72 hours, I think we're still headed to a year of action ahead. So now everybody knows where they stand on crypto, and there's people on each side of it, right? And what will happen next is those that want to adopt it and bring it into their world, whether it's at the state level, federal level, agency level, et cetera, or corporate or institutions, and those that want to not have something to do with it, and they're gonna make their stance and their policies around it. So this is going to be still transitionary for quite some time as we watch that regulation come out. You also have a little bit of a land grab happening. If and when crypto becomes as lucrative as it should be, that's helpful to a regulator to have that exposure to it and control that. So the hard part, and I think for as an investor, as a business owner, for myself and Mike, navigating these waters it hasn't been exactly clear. The clarity from each party hasn't been great, but the overall conversation has been positive, and that's been positive since even 2018. I know that when we went through something similar to this cycle, but it was the ICO Paris Hilton chaos of the day. Google shuts down all advertising, so does everybody else. It's a cleaning of the house. That era was about standing up and talking to them, not running for them, talking to them. We had some great conversations with some of these groups, whether at the state or the federal level. You could see there was a genuine interest in where this was headed. And now, headed into 23, this is the year of action. We're going to see it put to play. A lot of big countries making posturing moves too, just in the last 3 weeks. So it's an interesting time, irregardless of what's been happening at the niche level of Binance and FTX.
And Chris, let me tug on that thread a little bit. Not to get too deep in BitcoinIRA, but I think BitcoinIRA itself is a great kind of a case study around what's possible for people to get into crypto from a retirement accounts perspective. What does that landscape look like, and how has that developed from your point of view?
It's been interesting. Obviously, when we first started it, we were doing just press releases in 2015, 2016. And sometimes they got picked up and sometimes they didn't. It just was what it was. And you had what I call my engine nerds, the early guys, the NASA, the IBMs, the Mike Belshes of the world that saw this future and wanted to do something with it in a tax-deferred setting. What's really interesting right now is this year, probably of the 7 years we've been doing this, the largest amount of either cash or other alternatives sitting on the sideline relative to crypto. And that's because we saw a drop with what happened in Q2 in the spring, and now what we're seeing now. What's happening is this is becoming a clear re-entry point for a lot of those folks that were sitting on the sidelines. Our transaction volume, which has been a difficult thing for almost every company in crypto, it was down drastically last month. We've done almost our prior month's volume in just a short 72 hours. So the long-term believers in this that may have been sitting on the sideline for a while watching all this flush out have started to make moves in this is where we're headed, and they're not running off to XYZ other alternative asset.
Hank, I'll turn it over to you for a second. In the realm of alternative assets and how you view this space, do you have some sort of ranked priority of how crypto stacked up to others, or how you've seen it develop over time? How do you view crypto versus the other alternative assets at play here today?
So it's an interesting question. The way that I tend to think about the markets in more macro perspective, there's not any single asset. In my mind, it's all these assets relative to other assets and trying to anticipate the way they'll behave in various periods. And one thing I would say is, developed markets, the U.S. market in general, right? We tend to have the strongest legal protections. We tend to have the deepest capital markets. We tend to have these fundamentals, right, that make the capital markets work well. And yet, the U.S. of A. is confiscating yachts, taking apartments, right? Germany is nationalizing refineries, right? This is supposedly in the Western world where you have a rule of law, okay? At the very same time, you look at policies around the world as far as, we've weaponized the U.S. dollar. We've kicked countries out of global payment systems. What's the impact of that long-term for the reserve status of the U.S. dollar? So as an investor, it's not so much that I look at Bitcoin in exclusion of everything else. I say, you know what, all those things I just described are potentially very bad for a lot of other things I invest in. And yet Bitcoin would be sheltered from it, right? And I mentioned earlier, I'm in Dubai right now. I spent a lot of time in Hong Kong in the mid-late 80s, which to me was an incredibly exciting place to be. Dubai today is what Hong Kong was in the late 80s. And you hear the talk of People are not talking about the U.S. as a safe haven asset. People are not talking about the U.S. as a place they want to stash their wealth to be safe, right? To the contrary. And so as a global citizen, or as a global investor, I look at Bitcoin as a way, so many of us that have a libertarian background tend to, is, okay, given the nature of that, and to the extent the U.S. and developed markets are as unstable and as unpredictable as they are, look at our geopolitical environment globally. Look at the political environment just in the U.S., right? And so it's those reasons that I feel that, so strongly about that. Bitcoin, I don't really know, candidly, do I care where Bitcoin will be 3 months from now. It's really not why me as an investor invest in Bitcoin, right?
Love it, Hank. Global citizen with global outlook.
Let me add one more comment on here,
No doubt,
Thomas.
Yep.
I think the fact that there's so much regulatory look at digital assets right now is a sign of some success and a sign of recognition by the industry, by the regulators, by investors, that this is an asset class that we need for the future. And, of course, there's lots of new ways to think about, monetary systems or securities or whatnot. And this one is taking root in a way that's pretty serious. So, BNY Mellon announced last week before, that they are now taking custody of digital assets. This is a huge, huge step forward. If you're not aware, BNY Mellon is one of the top 3 custodians in the world in the United States. We got BNY, Bank of New York Mellon, State Street, and JP Morgan. Those are the top 3 trillions of dollars of assets under custody. And these guys are stewards of risk. They are a institution that's actually recognized by Treasury as a systemically important financial institution. And they think that they need to be participating in protecting crypto. So look, it's a start, and I think we should all be really actually happy that the regulators are here helping sort this out. And of course, because it's so new, we're going to see something hopefully different than what we've seen before. We have never had kind of this bearer instrument type capability inside of an electronic element. And those 2 properties make it unique and make it worth looking at in a different way.
That's right, Mike. I do want to tie in one of the questions I see here on the chat with what you just said. So Ruth had asked a couple minutes ago, do you think institutional investing will be the ultimate driving force of increasing price action? I know we have a lot of thoughts around that, but I think what is interesting and a theme that we've heard from the regulatory landscape is SAB 121, right? So if we believe that institutional investing will ultimately have some sort of driving force of price action, of course, but what underneath that mechanically, like what are all the tactical things that are going on? SAB 121 is one of them. I think it would be apt for us to educate the audience on what that is and what we're seeing downstream of that guide. Mike, can you give us a quick background on what SAB 121
All right, SAB
is?
121 is Staff Accounting Bulletin. It comes out of the SEC. The SEC is trying to figure out what's the right way to do accounting for digital assets on public companies. And so they created a first pass of that, which has some impacts from an accounting perspective and from a, how banks can hold digital assets. Look, I think it's a first pass of many, and it's raised probably more questions than it's answered, actually, kind of in its early implementation. It just came out a couple of months ago. So that'll get worked through. I think the broader question of do institutions drive kind of the next wave? Look, I have to believe they do. There's a lot of safety and comfort that people get when they are using their trusted partners to access digital asset markets. That is, do you want to figure out how to do it yourself? Do you want to evaluate relatively new institutions that you may or may not feel comfortable with? Now, some people do, and they use them today. Coinbase, fantastic institution. But sometimes you want to be able to do that through your broker and things like that. I think the number one thing is the approval of a Bitcoin ETF would actually drive tremendous adoption. It would actually provide tremendous investor protection, tremendous safety. I think the SEC will get there, but so far has still not been able to kind of come around on it. I think mostly because the technology is new and they're still learning.
Yep. It's been out there for some time too. And just to springboard off of that a little bit, Ruth had some other great questions. There was in there as well, and thank you for all those, Ruth. If we are going to make a transition in this fashion, it's going to matter what institutions can do with it, how fluid it can be for them, and how risk and security can be. Something that folks have learned earlier this year and recently is that exchanges really aren't your long-term storage facility. And so institutions have been working really hard to figure out, how do I make it so that I can make this asset secure while also making it fluid enough to keep up with the demands of the industry. And that's actually something that Mike and myself have been struggling with from an institutional and retail's perspective, the questions that come from us. So what BNY Mellon is doing, this is an indication that they're going to spend a good amount of brain power and bandwidth to find the solution that fits best for them. And that will spread into other institutions wanting to offer the same thing at the same level.
Just to add on to that, Chris, Regina had a question about headwinds. The institutions are further along than we think. There's news about BNY dipping in, right? But that's been at play for years, right? For very large institutions, they've had people looking at this since 2015, 2016. I'm certain of that. What's happening is they have to operate at a very different level of standard of care. They operate with very high level stakes at play, right? So from that perspective, they have to be slow moving. When you're moving billions of dollars of assets around and opening a new asset class, you have to be deliberate. You have to be careful. So of course, some of the risk there, obviously from the regulatory perspective, as we just discussed, but also the security aspect, right? When I first got into this space, I was looking around in 2017 and thinking, all right, how do we get institutions? People are saying institutions are coming, but they're not really here yet. And I would say they're kind of here today, but not really. What does it take for them to come in? And back in 2017 on a Laura Shin podcast, right? Can't remember the panel of folks on the podcast, but they all said, we need to solve custody. We need to have a way for regulated, secure custody in order for institutions to feel comfortable to get in and then open up the space. That, of course, alludes a little bit to what BitGo does as a business. And Mike, would love to hear what you're seeing in terms of the institutional space. Like, what are some catalysts from the security point of view or technological point of view that would help these very large asset managers, ETFs, get comfortable moving into
this is what we've been working on. So I'd like to think that we made some inroads over the last 10 years. I mean, it started out with solving just the base technology problem. You know, private keys, which you hear of a lot, are a difficult thing. People lose them easily. It takes some really good software to provide protection against, you know, accidental losses. That's mistakes that we make as humans, as well as from theft. So we had to work a lot on that. Second, we had to put it into a regulated, compliant context that's familiar to traditional institutions. You know, that's building out a trust company. Today, BitGo has actually 4 trust companies. We've got New York, South Dakota, Switzerland, Germany, with 2 more coming soon within the next 6 months. All of this is about building a really solid regulatory framework that institutions know that they're not dealing with someone that's going to cause them to get into trouble. We also have insurance behind it, which provides a good backstop. And then next step, I think, is about, you know, building more market structure so that it fits kind of the checks and balances. We were talking a little bit about FTX earlier to help them. But the point is that institutions are ready to participate now, and they have been doing so. We have seen nothing but continued bullishness from institutions about digital assets, and they're really working on, you know, kind of just knocking down all the concerns and removing risk that they would normally want to look at. Some of the early institutions are able to do that now, and some of the more conservative ones are taking more time. But again, like, you know, I used BNY as an example already. We're getting pretty deep into having this integrated with traditional finance.
Agreed.
There's a question from Brittany that I want to address specifically as it relates to security. Brittany asks, as trust is crucial, do BitcoinIRA account holders have some sort of access to our public keys or any other way to ensure transparency with their funds? And are insured assets fully covered if somehow multi-sig wallets become inaccessible? I know this is the pointed question, but I think we can start here and extrapolate.
And it comes to the overall security component. So Mike was just touching on this concept of custody for institutions. Brittany is an example of a retail buyer that we work with regularly every day, and they have the same questions. How are you going to keep me safe? How am I going to know I'm safe? And what kind of insurance around? And when Mike and I started working together way back when, there was no such thing as insurance. The Lloyd's of London wouldn't even answer your phone call if you were a Bitcoin guy. They didn't even know who you were. What Mike and the team there have been able to do is build configurations around how keys are managed, obfuscated, broken apart geographically, all these things, and then how they're accessed to co-sign and sign transactions. And then what we put over the top of it is your greatest risk is actually your individual client at the retail level. So if they are compromised, you've heard of SIM swaps, people losing things all over the place on Coinbase over the years, or losing the seed key, the guy that lost $250 million a couple of years ago, that was all over the news, right? So then you have these elements to it. And what we put was a fintech technology platform that made it so that you could just easily open, fund, and trade the account without the headaches of all of those things. And working together with BitGo, and what they were focused on was finding that insurance. And they were the first to do it and still carry the largest insurance policy available because of how things are set up. The insurer doesn't come in and go, well, I guess that Bitcoin's safe. No, we have to educate them. So this is how it works. This is the layers. This is the protection. They look at that configuration and say, you know what? You guys are running this the way it should be done. And so that's how you get that insurance badge of approval that comes to it. So great questions, Brittany. The essence is that you're accessing your account in an OTC segregated fashion from the actual Bitcoin itself, so that it's safe from any compromise that might happen or any breakdown of that chain along the way. Hank, you actually have been a client for some time. I think you were one of our first 50. What are your thoughts on how that breaks down?
Well, and let me pose a question back to you first. I think it follows up to her question. Talk about, if you would, and maybe this is for you and Mike as an investor, talk about the notion of being a trust company and segregated assets versus what may well have happened in FTX. Talk about the distinction of that, if you would.
Mike's the expert at custody. I'll let him jump in there.
And I'm sorry, I broke out the distinction between FTX and which?
Well, the idea that trust companies such as BitcoinIRA and BitGo in this case have segregated assets, right? Versus what may well have happened with FTX.
Well, when you look at the market structure in any other asset class, you're going to find, instead of having single entities that take on all functions, the responsibility for helping you manage your assets, fund your assets, exchange and trade your assets, settle your assets, and store your assets are divided among different parties. Now, one of the problems with that setup is there's a lot of middlemen, but over time and with efficiency, you get a lot of that worked out. And I'm not advocating that we replicate exactly what exists elsewhere, but some of these separations provide tremendous investor protection. And in particular, what you're hitting at with trust custody, or what you get with a bank, when you put your assets with a custodian, those assets are your assets, and they are not the exchange's assets, which means if the exchange goes bankrupt, those assets can be isolated or remote from bankruptcy. Now, there's some different ways to use custodianship, and some of them have this property and some don't. So not all custody is equal, but it can be done properly is the point. And what you want to have is you want to be able to go and trade on a particular exchange. You want to be able to have your assets, available for those trading activities. But if the exchange is taking risks, you don't want your money to be wrapped up in their bankruptcy because they took a risk that wasn't part of your risk. And this is what market structure does. It starts to break that apart. It also has one other very important part. Digital assets, blockchains, number one thing is transparency. You get an amazing amount of visibility into what's going on as a result of allowing everyone to be able to see the activity. There's also some problems with privacy, still some work to be done there, but the transparency helps fix problems where somebody might not be quite as candid about exactly which assets they have or don't have and what they're buying and selling. Separating apart the function of trading from the function of storing. Well, it's very different disciplines. One is about security and safety. The other one is about usually access to liquidity, movement of funds quickly. Those are very different. But secondarily, if you just separate those, you now have two parties that are responsible for adding up the money every day, which is really what you want. If the exchange says he's got $10 billion, you want to have somebody else that says, yes, we got it. There's $10 billion.
This is a good segue into Billy Joe's question as well, which is how do recent disruptions with large DeFi players, Celsius, FTX, Voyager, right, hinder the public trust in crypto institutions in general. I mean, frankly, I could take this one, right? It's a setback. Nobody likes to see large, FTX. Celsius, of course, had its own reputation, but FTX, everybody thought up until this week was impregnable blue chip institution, whatever that means in crypto, right? Trad crypto, if you will. But if we actually examine mechanically what went wrong, it's a story of risk management, right? How do they run their business? How do they account for bankruptcy, remoteness, etc.? If you look at the fine print, like what Coinbase did when they released their 10Q, people looked at the fine print and realized that as a user, myself included, in Coinbase, my funds I actually become an unsecured creditor if the exchange goes down, right? I'm sure the same thing is happening with FTX, which is why many people are experiencing withdrawal delays. And there's some other exchanges that are coming to light right now, right? So it's not, FTX is probably not going to be the only one when this is all over. The second part of Billy Joe's question is, what do you think it will take from institutional regulatory perspective to reestablish trust in crypto and DeFi? Regulation certainly helps. The lack of explicit clarity from regulators obviously allows folks to go off and invent whichever protocol. That plus security and really a real understanding of risk management and operational maturity within these large funds.
And the test of scale, right? So there's a reality that comes to play when you get big enough. As an entrepreneur, you build something with a dream. And then there's steps along the way where you're like, okay, we've got to change this, this, and this. I remember the transition from 17 to 18, before even the ban on crypto advertising happened, our board had added a CTO and a chief compliance officer that was from the FDIC investigation unit for financial crimes, because we knew that what was coming was you have to evolve your business, mature your business to be ready for the next evolution. What we're seeing here is as these exchanges are scaling and then they're going to the next layer, which is DeFi and being a CeFi inside of what DeFi offers, there's these elements and then tokenomics on top of it. I think Hank said it earlier, there's an interconnectedness to it because the overall industry is too small that if one has an impact, you're going to see it happen with others. The guardrails of regulation are what are going to make the client feel better or the end customer feel better, but they have yet to be fully defined because we're walking into a space that's so much different than what even we've seen before. I'm 37, my daughter's 8, and I'm out of touch with what my daughter's doing. I honestly, there's so much that is happening in her world in technology and how these things are affecting them. Same was true for my generation of my parents and my grandparents. And we're getting to that next evolution. And I know we haven't talked about it yet, but maybe a good pivot for us is into last night's midterm election results or ongoing results from last night's election. Is I think that this was a little bit of a referendum that, as exit polls showed, the economy is bothering people, but as results are showing, it's a split race. It's a split ticket race in some situations. People don't necessarily know if who's in charge right now is going to be able to shepherd us and lead us into the next evolution of finance, money, et cetera, with Web3 as a part of the conversation.
Absolutely right. And before I forget, I'll just reiterate as a disclaimer, we're providing information here today for informational purposes only, not acting as a financial advisor or investment professionals. Any personal opinions that we have here should not be construed or relied upon as financial advice, and we're not here to recommend any cryptocurrencies. On that note, I will tackle Bruce's question here, which is, with the volatility of BTC, is there any thought of investing in startup altcoin projects while BTC seeks a bottom and rebounds? My response here is a 4-letter acronym that crypto Twitter loves. It's DYOR. You got to do your own research, right? And to borrow Hank in his notion of fundamentals, right? Are there fundamentals in crypto? I think there are. They just look different than what we're used to in traditional businesses, if you will. And so if you want to invest in these altcoin projects, anywhere from like a Solana, which is more established, to your esoteric longer tail coins, you better have a good understanding of what is the problem that they're trying to solve, right? The larger kind of pulling back from the actual fundamentals a second, the larger things at play here are also considering, one, a lot of these VCs raised money in the last year, beginning of this year, and have a ton of dry powder to invest. Their mandate is to return the fund. We're right now into a crypto and a macro winter everybody's building. So these very large funds will have to look for somewhere to deploy as well. So what I mean by that is I think there is an opportunity for the next wave of, just take a step back. The last time we had this in 2018, Solana came out of 2018, Avalanche came out of 2018, some of these other more popular L1 alternatives to ETH, right? The same thing could be happening now, right? As long as you understand the use case, what they're trying to solve. I think there is opportunity, but of course, myself, I'm not a trader. I don't have one hard view.
Well, real estate guys.
I would add on the regulatory side, the challenge of regulation, I think the industry has been too scared of regulation. I think over time, regulation will be good as the industry matures. The challenge, though, is unlike many industries, this industry trades 24 hours a day all over the globe. And what will happen is you will get regulatory arbitrage, right, as various markets set up regulation. You'll see companies move. We've seen that with Singapore. We've seen other places. And so it's going to have to be a global concerted effort, which is very hard, right? That's part of what's going to take long, and it's part of what will be difficult.
You mentioned regular arbitrage. I mean, that's how Alameda Research came to being, right? They start off as a market maker, taking advantage of regulatory arbitrage across different time zones, and then launched FTX with the help of Binance later on.
I would just throw in, Ron hit it pretty hard on the head in the comments, utility team community. I've always said, real estate guys will tell you over the years, location, 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 which is true. If you have a beachfront property, it's pretty good, right? Utility has always been my battle cry for crypto. I've watched when we brought ETH in, it was at $40 in 2017, and where it's grown from there. Our first Bitcoin was at $250. Our first BitcoinIRA buyer bought it at $250. If I've seen, thousands, right? We've seen thousands. Hank's seen them too. If they're not solving a problem that they may not be making up themselves. Mike said this at the Activate conference at BitGo in Palo Alto a couple weeks ago. Sometimes we think up a problem that people want a solution to, and they really don't want it. It's like, you know what? I don't need that. KYC was a good example Vinny Lingen put out there at the conference. So I always try to find okay, where's the solution they're solving, and what does the price indicate of that? You've seen where I think Hank and I saw it in 18-17 transition. Bitcoin ran. People felt left behind. Ripple was coming in. People didn't understand what Ripple was at that point in time, but they thought it could go from $5 to $50,000 because it was the next Bitcoin. But they're so fundamentally different of what their use case is and all those things. So if Ripple costs as much as Bitcoin, then it would actually probably not be able to do what it does as far as a competitor to Bank and Swift and those types of things because it'd be too expensive. It would price itself out of being a competitor to the existing paradigm. So utility is huge as you do your own research, as Thomas said.
Another angle to look at this is I firmly believe that community is the only moat in crypto. So what happens when you have like ETH, and if you're a developer and you want to get into blockchain development, smart contract development, etc., you look around and the ecosystem on ETH is pretty robust. Do you want to take a chance there and where it's competitive, or do you want to build on this other L1 that's coming out, which there's not that much adoption, right? So the community aspect does create gravity around a particular L1 or an L2, and it does attract developers. And of course, that in and of itself is a flywheel effect that you can capitalize.
Just like those same guys did with React versus Java versus all the different code languages that you build.
Linux.
Linux. Okay, I'm not that old, right? But I remember Linux just a little bit.
Right, it's not necessarily the best product that wins. It's the one that most people use, right? Has most adoption. Also, with the price action and everything retreating 80-90% from all-time highs, I think a year ago, Bitcoin was at its all-time high of 69,000, right? It's come down significantly since then. That allows room for people to come, new entrants to come in, because a lot of developers who are building on ETH, hey, if I'm building on ETH at 1,000, right? And there's more upside than if ETH was at 4,000. So yes, it does wash out, call it paper hands, if you will. Liquidity has been taken out, but it also gives a chance for new innovators to come into the space.
Agreed entirely. I just want to do a time check, Thomas. We close at noon, right?
Correct. So we've got about 10 minutes or so left. Let me answer Regina's question, and then there's some questions that were submitted ahead of
Oh,
time.
I wanted to
Make
answer
sure I cover
Regina's
those.
question. I thought it was a great question.
Well,
So Regina
might
asked if not Binance, who would and why bail out FTX? One thing I want to point out is that this is going to be a self-healed, inflicted wound, right? It will self-heal itself because we're not big enough for the government to come in. There will be no walking up to Uncle Sam and asking for a check to bail us out. It's not going to happen. And I think that while I know that it's because we're younger and we're maturing a growing asset class, that's pretty unique. Now, if not Binance, there is a lot of value in any business. Ask Lehman Brothers 08. They didn't just disappear. Somebody bought their building. Somebody bought their book. Somebody bought these things. They got broken in pieces and those things. So what will be the net to it will be those users at FTX and those holders, et cetera. If things hold up that they can be made whole, which we're seeing in tweets, but we don't know yet because we haven't gotten under the hood on this, that there's value there. So yeah, somebody or a group of somebodies will probably walk in. Hank probably has seen something like this in his past where a niche industry, a player in it started to fail, and others will come in and bring it to fruition, not in a taxpayer paid bailout, but in a industry-wide bail-in almost.
And I would only add that no matter what the scenario is, Binance is probably the biggest loser, right? The reputational impact on the market, this is not a good thing for Binance in any scenario, whether they end up with FTX or not. And so to the extent they do participate, clearly it'll be out of their own self-interest and trying to minimize the damage to the marketplace. But this is not good for Binance.
Yep.
all right, I'm going to pivot over to some questions that were curated ahead of time. So one of the questions is, when will government central bank cryptos, I'm assuming that's central bank digital currencies, CBDCs, become important in this market? Will one country's government crypto be best?
I'll tell you a very quick stab at that as an investor. I think that the market tends to confuse, if you will. In my mind, they are entirely different use cases, and they can entirely coexist. And there will be, the challenge with central bank digital currencies, China is maybe the best example, right? Is now all of a sudden it's the exact opposite of what we're trying to do with decentralized finance, right? You've now given a centralized party all of that access, all of that data, all of that control. But in general, central bank currencies will have a very different use case than the currencies that we're talking about, that you're going to, international transfer of money between private individuals. Bitcoin, you have yet again a different use case. So I don't see them as one or the other. I see them as potentially both, but central bank digital currencies will have a significant negative, if you will, if you're in a totalitarian place such as China.
Yep. Because what's missing in the conversation is two things. There is a transparency of supply in crypto, and most of the time. There are some that builds and builds and builds forever, which is kind of like fiat currency. But you know what the fixed rate will be. That's not necessarily the case of any currencies that may have CBDCs associated with them. And then the next piece is something that I think, Thomas, you had mentioned we wanted to talk about towards the end was what's the piece that people aren't looking at? And I think it was Ron or somebody else in the comments brought up halvening. That is a core element of the protocol for Bitcoin in particular that helps it have that finite supply to it. And that is the exact opposite of how fiat currency works, because we take reward away from production in Bitcoin, right? As more is created, the reward is cut and cut and cut and cut until it's down to smaller and smaller amounts. When you create more currency, you actually kind of get a benefit for doing it. And last night was a key example. Elections, people vote with their pocketbooks. What we went through with COVID, we had to bail out portions of the entire society because the economy was shut down. These are the things that you won't see happen in some of these protocols. That makes it a little bit different, where CBDCs are going to have to challenge themselves to live in that world they've created alongside some kind of ping or otherwise. And that's the part where it hasn't been defined enough, I think, for people to be 100% comfortable. Now you take that away from developed countries, right? I'm talking US and Senate. Now let's go down to underdeveloped or those left behind. What I love about what El Salvador did, instead of creating its own central bank digital currency, just adopted Bitcoin. And Costa Rica is looking at doing the same thing possibly next year. If that failed, you would have El Salvador hat in hand to the IMF and World Bank saying, we need help, this didn't work. But we don't see that right now because they found themselves their own ecosystem around this. So you have that use case where it's like, why would I need this when I could do this in comparison? And I think Hank hit it hard, is when you're dealing with totalitarian or any version of that, it changes the entire landscape of the conversation.
Yeah, I would say CBDCs, at the end of the day, it's really about control, right, in different forms. In China, the two biggest tech players were Alibaba, Ant, or Tencent, right? And all of a sudden, the government realized, wait a minute, they're collecting all the users' data through the checkouts. So if anybody has been in China in the past, you probably see you could check out with Alibaba or Tencent. All of a sudden, you get the government's EC and Y there as well, because you know what? They want a piece of the action. They need to make sure that they understand how money's flowing within the country because they're trying to control outflows. I think similar with the US, right? If you think about the US, if anything, crypto is a good test environment for the US government to see how all these stablecoins are playing out, frankly. USDC is probably the most prominent, and one could argue that they're on track to being nationalized even, given what happened with Tornado Cash, not to get too esoteric in some of the instances that happened in crypto lately. All right, let's move on to another topic. This one's a little bit specific for Chris. Do the same tax benefits apply for Bitcoin IRAs as traditional ones?
Yes, that's kind of the best part, is our perspective on this whole industry has been driven by the challenge was, okay, in order to have an asset in your IRA, it has to have an arm's length distance between you as the holder of it and your IRA titled for it. So there's your core. And so we had to build a solution that kept all that happening along the way. And at its core, it does exactly the same. Whether you have a traditional and you contribute, you have the tax advantage. And then when you distribute, RMD kicks in at the same age. All those things are the exact same, whether it's traditional, Roth, SEP, or simple. What changes is just the asset class that you're able to invest in using this turnkey fintech platform.
Great. Thanks, Chris. All right, I got another question, two more. One is, please explain the blockchain technology, its future use case, and how one benefits from having it in a portfolio. I think that's two different questions. I don't think we have enough time to explain the totality of blockchain technology, but we can talk through a little bit of the use cases that aren't as readily apparent, right? And then I'll defer to Hank to talk about the benefits of having it in a portfolio. In terms of the different use cases of blockchain technology, right? I think ultimately it's an immutable ledger that has visibility from all parties. So some use cases initially are, all right, let's just track supply chain logistics, right? You'd be surprised. For example, I didn't know this until like a couple years ago. When you buy something and they're freight shipping it from one country to another, oftentimes the ship just disappears off the grid, and you're like, where did it go? And then it'll pop up on the grid most of the time, right? But understanding like what are the sequence of events that happen, that's an interesting use case. It also creates can facilitate scarcity in the internet. In an internet world where everything is pretty abundant, right? You can copy paste this or that. But if it's on a blockchain, and if it's specifically an NFT in the form, whether it's art and culture or titles and deeds, all of a sudden you attach it to a specific blockchain, to a specific block, and it's immutable and it's there. All of a sudden you created scarcity where in the internet world before, a lot of it could have been faked. So that's top of mind. I think that's probably the easiest conduit for mass adoption, which is through arts and culture. Because Chris,
I would
I'm
add
sure
real
if you
quick
ask,
also for the average person that might not understand blockchain. So authenticate, immutable. Imagine of all the things in our daily life, right? We all pay for title insurance. We buy a house. Do any of us know anyone who ever collected on title insurance, right? If you instead had an immutable record of every person that ever owned that house, right? Imagine getting NFT when you buy your next car. And on that car, it automatically records if there's ever an accident, whether you've been speeding, every time it's been serviced, and that's an immutable record that forever stays with that car. So this is where we're going. It's those things in society that will be attached and provide an immutable record. Something so simple as the mileage of your car, right? Mileage can be manipulated, right? You buy a car with 40,000 miles, it might have 80,000 miles, right? So it's just authenticating that data and making it immutable.
And with the same argument of Thomas's about scarcity is the privacy that comes with that. So a lot of our information is out there. We all talk about it. I bet everybody that's at this webinar will see an ad about crypto. in the next 24 hours on any of their social channels. It's just how it works. And there are maybe ways with Web 3, 4, and 5, as Dorsey's already talked about from Twitter, is where we can maybe take a little bit of that privacy back about the things that are important to us, while still also having an immutable concept on the ledger that counts and can be used. When I was first starting this, my grandfather was 86, and he asked me a question about Ethereum. And for me at this time, this was 16, 17, the one that made the most sense for me was, if we go to the doctor, we go to a new doctor, and they give us that clipboard, even if they're not new, it's like a new policy, they give us that clipboard. We got to remember mother's maiden name, XYZ, all these things. There may be easy solutions where those things are applied, that you can walk in and share that information securely, and then close access to that information securely, bring back some of that privacy that we're all looking for online and just in general in this new world order.
Yep. All right. In the interest of time, let's go to the lightning round. 2 questions really quick. Number 1, again, disclaimer, not financial advice, not real predictions, just getting a sense of where you guys think it is. Number 1, how long do you think this winter will be, and where do you see BTC and ETH price at the end of next year? And then number 2, what's one thing that nobody's paying attention to but should?
Hank?
I'll start with Hank.
Oh, a year from now, who knows? I think 3, 4, 5 years from now, I think there's a host of huge risk in the world as an investor: geopolitical risk, macro risk, fundamental risk. Regardless of how those risks play out, I think Bitcoin and tokens that have a very specific utility and use case will be materially higher, not just from where they are today, but where they were at their highs. No idea a year from now. Candidly, I don't care. But 3, 5 years from now, I'm quite certain with that. What are we not paying attention to? I don't know. I'll leave that for somebody else in the interest of time.
Yeah, absolutely. I would have to, my compliance officer is probably wringing her fingers right now, wondering, what am I going to do? Of course, I'm not going to give a price prediction. I'm well trained, but I agree with Hank, when in doubt, zoom out. So where are we going to be in 3, 5 years? Finite assets versus infinite assets. What's happening macroeconomically? What's going to change over that time period? There's so many reasons why you want diversification in your life. And crypto is a sliver or a piece of your pie for diversification. So it makes sense getting off zero at minimum. So yeah, where we'll be in a year, who really knows at this point? This has been quite a last few 72 hours. And what are we not talking about? I just mentioned it, is the halvening. It's coming up soon, 2024. And around each of those, if you look historically, there is some pattern of price movement on the upside, because everybody knows that production will go down if the way it's produced, right, is there's miners get in and they bid for it. When you cut that reward in half, you're going to price out a big chunk of that market, which is going to constrict supply. That's what it's designed to do. And that's not something you're going to see in any other asset class in the world for the next 10 to 15 years. And that's going to keep happening and happening and happening as we get closer and closer to final production. So keep an eye for that one and what that will do over the next 18 to 24 months.
Absolutely. So just to conclude, I would say, to summarize, all 3 of us have seen multiple winters. And just like it happened last winter, what we tend to do is put our heads down and start building. And I believe, and I think you'll share the same sentiment, that the next bull cycle, whether it's 2, 3, 4 years out, is going to be better than this one, because the market infrastructure is going to be so much better as well. All right, so that's all the time that we have for today. Thank you so much, Hank. Thank you so much, Chris. Thank you so much, Mike. I had to jump a little earlier. Thank you, audience, for your questions, for your participation and attention. And hopefully we'll see you next time. Hopefully there's
Thomas,
guys.
Thank you.
Thomas, just to add real quick, so many great questions in the chat. If they didn't get answered, something really unique about our BitcoinIRA platform is we have analog real human beings that can answer some of these unanswered questions. So feel free to take a look at us, reach out with some of those ones we may have missed today from you. And it was great seeing folks like Ron and Ruth out there. Thank you, guys.
Fantastic. Thanks, everybody.